Hey everyone, welcome back to the channel. Today, taking a look at Uber. This is something that's actually interested me for a while, just with the pandemic, to see kind of how their business model's changed and what's going on. So, I'm going to kind of just do a quick little evaluation here and kind of look at some of the key things that have changed in their business model really since um, the pandemic. So, first, let me just go ahead and open up. There's a bunch of tabs from the last video I made on sports cards. Let's go over to Yahoo Finance. And let's go ahead and check out how Uber's doing. My guess is they've probably done pretty well. I think they announced an acquisition recently. So they might be up on something like that. So yeah, last month, what they were at 54, about flat. 6 months, so yeah, they're up since August. Let's look at the last year. How are they doing? So, the pandemic, they dropped down to the 20s, and they're back up at the 50s. What did they originally IPO at? I think it was like the 30s. 46. It's probably, I'm going to guess, right? How long have they been public? So yeah, they IPO'd at mid 30s, it looks like. So they're doing better. And a lot of the growth has actually just came since November, really, it looks like. They spiked. And if we look at, I want to say they announced, was it DoorDash or something? What did they acquire recently? Postmates. That was July. Is there something else? I thought they, oh, Drizzly, that's what it was. They announced Drizzly a few weeks ago. Got it. And that's an alcohol delivery service, if you're not familiar. Very similar to Uber Eats, but delivers alcohol. So, anyways, let's go ahead and I've pulled their financials over from their most recent 10Ks and Qs and just kind of a handful of statistics so we can kind of get an idea of 2020 revenue. So they have 9 months ending in their most recent Q. So to get the full year, what I did is I take the 9 months ending of 2019 divided by the full amount. Obviously, this is not perfect, but we're just going to kind of hold the same patterns consistent, and we can kind of get a rough idea of the full year 2020 by then you take the 9 months, divide by this percentage, and you get a full year 2020. So you can see full year 2020 estimate is actually below 2019, which I think is as expected. And if you look at that, the big driver is mobility revenues. So that's really just a decrease in their taxi service. But you see their delivery, which is Uber Eats, Drizzly, Postmates, all of that stuff is almost doubled. Their freight business growing steadily. That's pretty good growth on 700 million in revenue. And then other is on pace to grow just slightly. They have some miscellaneous like tech, other bet kind of things. They weren't really anything too crazy, and it's not really growing too much. So didn't want to break it out. They don't break out cost of revenue, unfortunately. I couldn't find it by segment, which I think would have been very telling. They do have adjusted EBITDA by segment, and their mobility is the only thing with a positive adjusted EBITDA. But then if you layer in the corporate expenses, even that's not profitable. And you can see delivery losing money, freight losing money, other losing money. So all their other stuff is very unprofitable. Their mobility is profitable. And honestly, even looking at that though, you have a 50% reduction in revenue almost, or probably 30%, but EBITDA is hanging in there. So we'll go ahead and link this up and think through a few different kind of growth scenarios and see what we can get at for valuation today. So first off, just link these back, mobility. I should be able to just copy those over. This one needs to be updated, I think. And apologies, I added in some rows and it looks like the formatting's all a little weird, so let me just kind of paste formatting and see if that fixes that. Have to times it by 1,000. There we go. Well, that's in millions. millions. So I guess maybe if I do this by 10,000. No, that's fine. We'll just multiply by 1,000. So we know that that's in, should be in billions. And then these ones actually need to be swapped out. So 2020 is actually going to be this row. There we go. Multiply that by 1,000. Okay. There we go. So now we have rough estimate here for revenue. I'll bold this just for now. We'll project out the revenue first. So first, let's just kind of look at how the revenues have grown. Just divide, subtract 1. Actually, I should be able to just copy this formula, I think. We can look. So other was 0 before, so okay. And then you can kind of see how total sales are growing. So we can see, right, looking in 2020, right, a big decline in mobility, but huge growth in delivery. But obviously, still overall a decrease in sales. So the first scenario we're going to kind of run here is, can we first get back to our baseline mobility revenue? And then from there, can we continue on kind of this low teens is what I'm going to go with. So I think for that, the first year, you're going to have to grow 50% probably, if not more. So let's see here. We'll just link this up. So 50% isn't even enough. So we're just going to assume they return to 2019 levels. So let's give them 60% growth. Nope, still not enough. Which, I mean, it seems like a lot, but in reality, if the world really does return to normal, everyone's back going out on Uber, XYZ, I think we could definitely see a return to normal for Uber here. So I think that this is completely and totally likely. And then we're just going to go with like a low teens percent kind of there on out of kind of based off, 2018 they grew, 2019, right, they were growing 30% and then 14%. So we're going to just assume they can we're going to keep it on the lower end for now. Let's see how all of this grows out. Yep, so then it becomes a $30 billion business by 2030. Okay, fair enough. And they could accelerate that, I think, obviously. If we look at their geography split, right, US and Canada is the biggest piece, but EMEA, and I mean, this is going from 2019 to 2020. So I would say if it's flat, that means there's still incredible growth, but it's just COVID is impacting it as well. And I didn't look for these breakouts in their K. It might have been in there. But the fact that they're flat in EMEA and growing in APAC, even with COVID, means those could be actually really big accelerators of growth for their mobility business. So a low teens might even be kind of underestimate. Delivery, I think this is tough, right? So COVID has definitely accelerated this. It's grown 100%, and that's because no one goes anywhere and you order all your food from home. I started doing my groceries delivered on Instacart. I order takeout probably a couple times a week now because I can't go out to dinner. I think you've just seen this kind of across the board by a lot of individuals. So the question is, are they going to continue to grow at 100%? I don't think so. I don't even think they're going to grow from that 2018 to 19 rate. I think they've really accelerated growth. Now, I don't have anything that proves that, but my thought is when the world opens back up on a Friday night, I'm not going to order takeout and watch TV at home. I'm going to be going to the bars with my friends, going out to dinner with friends. And I think you will, I don't know if you'll see a decrease or if you'll just see kind of a flat line or a slight growth. Because, historically they've had pretty insane growth, but it's, it's half as big as their, back here, right, it's a 10th, 12th the size of their mobility business. Here it's an 8th, here it's a 5th, and now it's basically the same size as their mobility business. I don't know if it's going to continue growing at that rate, so maybe I'm going to bring this down to 15% and just kind of see how the numbers work out. Obviously, I don't have a good basis for that other than I don't think they can sustain this incredible growth. And that's purely just because I don't think that the delivery business is going to be bigger than their taxi business. Um, I just don't. I mean, I guess it could be, but I don't. There's a lot more competition in that space as well. A lot of kind of local delivery companies in certain areas and things of that nature. So I'm going to give them still strong growth, but it's caught up to the mobility business through COVID, and I don't know if it's ever going to pass it. Is kind of what my thought is. So keeping it trailing just slightly behind and being the little brother, I think, is kind of my thought here. Freight, this is an interesting one. I don't know too much about this. I've like read high level that they've gotten into the freight business and things like that, and they're kind of doing trucking. Not super familiar with it, but obviously it's been growing pretty well. It's $1 billion business. So maybe we kind of give them credit for that, give them a couple more years of this high growth, and then just kind of have it decrease. Let's call it 5% a year, and until they get to like a teens. Giving them a lot of credit for being able to sustain growth, which I mean, a company this size being able to grow revenue 10% a year when you're looking at a company that's 50 billion is probably not realistic. I've worked at some Fortune 100 companies, and a good year for us was like 7% revenue growth, and our goal was to go from 20 billion to 30 billion in revenue over the course of 10 years. Right? We haven't gone from 12 to 20 in 3 years. Obviously, there's a big decrease here, so I mean it's really only 15 to 20, but still, I don't know. It'll be interesting to see kind of how they actually do play out, but we'll see. And look, I mean that's still a pretty healthy, good-sized freight business over time, keeps growing as e-commerce and other things grow, and yada yada. Other, honestly, I'll probably just hold this flat to the 9%. Over time, some of these other bets may actually pan out, become its own business line. You may see some bigger growth, but for now, it's a pretty immaterial amount, so we'll leave it pretty small. So, going from 12 billion to 56 billion, was that 4.5 times increase over the course of the next 10 years? I don't know, probably not realistic, but that's fine. Cost of revenue, let's link this up. And this is where I wish we could actually have the cost of revenue by segment. I don't know. The segments have different revenue breakdowns. I don't know what they are, and I wish I did, because I think that would be pretty telling of, which business lines are profitable or will they ever be profitable. We'll have to project that one out. So cost of revenue, it's been hovering around 50%. I think that makes sense, just based off their business model, assuming that this includes all the costs for the employees. Let's see, operations and support. I'm guessing that's like internal ops, like logistics. The cost of revenue has to be to pay the drivers, I would think, if you're at a 50% margin. So we'll hold this at 50%. And honestly, I think over time that's actually going to go up, not down, but maybe we'll give them credit. And here, let's see how. So yeah, we have total revenue growing. That's real. I mean, not super realistic, but 15, 14, slowly decreasing down. And then obviously a huge spike, assuming mobility comes up. But so COGS, I'm going to hold it 50% in this first scenario as we kind of run the numbers. I think honestly COGS goes up over time. The reason I say that, I see a lot of employment lawsuits, things of that nature, where it's, they don't pay minimum wage, XYZ, all these states are implementing minimum wage, things of that nature. So over time, I think that actually, well, I guess there's two arguments here, right? One argument is that goes away over time because we have autonomous vehicles and Uber's investing heavily in that, and they're going to pick you up and drop you off without a driver, and they're just going to have maintenance on cars. Okay, that's one approach. The other approach is that's farther off than anyone would like to actually admit, and we're going to have to start paying minimum wage, $15 an hour, et cetera, to these people, including benefits, and your cost of goods is actually going to rise as those costs increase. So I don't know. Maybe the neutral case is leave it 50%, and that's just things stay the same. You know, there's a little bit of autonomous driving in certain places where it's allowed. There's a little bit of benefits paid to employees in certain states. We'll just have to see. So Sgna, they have a lot of other lines here. So we'll ignore DNA, but we'll take G&A, R&D, S&M, and ops and support. And this is the part that's like, they spend a lot on these other functions. And then times that by 1,000. And then this one actually, because I didn't line everything up, we'll have to actually plug that as a percent. So let's look at SG&A as a percent. Right, so I mean, like clearly not sustainable. And if we look at this, right, like what are the pieces that are, and I mean, we could do, oops, just get an estimate. So yeah, maybe we'll do that for our estimate for 2020 here. We can just kind of see if they're on pace for scaling back their costs. What's that a percentage of still? Let's see, 80%. I mean, they got a R&D, right? They're spending, what, almost 30% a year on R&D, over 30% a year in 2019. My guess is that's autonomous vehicles. They're really trying to get in that market, really hoping it pays off. G&A, they've scaled back from 17 to 18, 19 it went up, 20 it looks like it's on pace to scale back. Sales and marketing, that's the other thing, right? They're heavily reliant on promotions, so that's a huge expense. Ops and support, I mean, as they're, especially as an autonomous vehicle fleet or anything of that, that would get more expensive, and I'm gonna guess their freight. So I don't know, there's a lot of things to work out here. I'm gonna hold them flat to start, and then I'm gonna give them a positive scenario here. I mean, they have to, right? Like, they're probably not gonna have a positive cash flow until they get these costs under control. Let's see how they kind of lay out here. I think I have it as a percent of revenue, right? Yeah, percent of sales. Okay, so we can, that might be high, right? So as we have revenue growing, scales, the costs aren't going to grow in a linear fashion. So right for, I mean, but I guess that just gets them back up to 2019 levels. Maybe that's fair when you increase your mobility. But let's leave that at 75 here. Just a little bit of growth. But I mean, they have to get those costs under control and the promotions and all of that. And I mean, that gives them a positive EBITDA, but not until 2027, which is just bonkers. DNA, let's link that up. DNA, there we go. This one up. That's 9 months ended. We'll just quickly. EBIT, right? Did my signs go the wrong way? Oh yeah, no, that's right. EBITDA, tax affected EBIT. Add back DNA, CapEx, we'll link in down below, and change working capital. It's CapEx, let's see. Got the CapEx. Over here, PP&E. So maybe we'll just hold this at 4.5% for now, depreciation. We're just gonna actually have to mess with a little bit of this real quick. Let's take our depreciation, divided by 0.8, there we go, negative. Okay, and then hold this flat at 4.5%. And that gives us what, a percent of revenue. And I mean, if we think about it, their CapEx is actually going to have to grow pretty significantly. It's not going to be held constant, depending on kind of what scenario you're looking at. If they're investing in autonomous vehicles, right, this CapEx number is going to go through the moon, right? Buying an entire fleet of vehicles that's autonomous is not going to be cheap or easy, but that's okay. Let's calculate. So that's fine. Here, at about 80%, what we're saying is, right, there's still growth CapEx, about, because if depreciation is 100% of CapEx, that means it's purely maintenance. They're not investing in the business to grow. And if you have growth assumptions, those just don't go together. So we'll assume some growth, and then let's go ahead and we can calculate this now. Can link all this up. So let's come back up here. Again, negatives. Paste that in. So here we go. Things are starting to kind of pull together. Let's see, 1.7. Actually think I want these numbers to be less CapEx. There we go. So now we can see, based off this, right? I mean, they're not cash flow positive until 2027. So that's not a good sign. But I guess the last thing here is current assets and liabilities. I got those right here. So 2018 is the first year I have. Current assets. This plus this plus this plus this plus this. And then times all this by 1,000. And honestly, I'm not expecting anything too material to come out of working capital. Now, is that right? Yeah, so I guess their assets shot up. If we look at it, it's cash. Probably did a big financing round or something, or that, yeah. But then if we look at 2020, actually, oops, it's over. That's okay. I was like, that's funny. Why is that the same percent? That's because 75 seems to be more in line. So set that to 75. We're gonna have to update. I'm guessing this is the same thing. So maybe we'll leave this closer to 45%. Just gonna pick something in the middle there. Let's see how all of this. So I mean, this is a maybe just, oops, set this equal to the prior year. I guess the big thing there is we have revenue growing, right, pretty significantly. So based off that, you're going to see some weird working capital kind of stuff in those years, and then things start to normalize out more. And maybe I'll just set that there. Will that keep things? I like to try to neutralize working capital. Maybe we have this decrease. I know this isn't exactly, I just don't like to see the cash flow driven largely from changes in working capital. That's silly in my opinion. Okay, whatever, close enough, neutral enough for me. Pretty sure if we come over here and look at this, it's gonna have a whopping negative NPV. Let's do 10%. Weighted cost of capital, a lot of people always ask, how do I come up with that? Really, that's like what you require as a return as an investor. So whatever you think you need. The S&P historically returns like 11%, with like real returns of 7%, 8%. So, you know, non-inflation adjusted, you're looking at 10 or 11%. So something like that. And then NPV to cash flows is negative 11 billion, which I guess makes sense. Terminal growth rate 3%, terminal value then is 115. NPV of that is 40, so 32, and then we want to subtract out net debt. So let's come over here. What do we have? Long-term debt. I think I got to multiply that by 1,000 for it to come through here. And we want to subtract that, not add it. Oh, I guess, oops, that's not net debt. Net debt is, sorry, it's going to be the sum of these less your cash. I did not take into account cash. There we go. And actually, we could probably take into account short-term investments as well. And then multiply that whole thing by 1,000. Oops. And we can kind of see what that gives us. Okay. So 31.2 billion is the equity value. Based off this model, let's hop back over here. What's Uber trading at? Market cap of 100 billion. So we're pretty far off. Even on a sensitivity, if you lower your WACC, right, increase your perpetuity growth, about 82 billion. I think the big thing you'd have to make an assumption around here, Sgna is a percentage of sales. Like, you're gonna need very quick to be able to like scale this down and get it back to like 30%, get out of this like hyper growth, start having a positive cash flow. But even then, I mean, you're still only at 50 billion. I guess the other alternative is you're gonna have to assume, you know, huge reduction in Sgna. And I guess on top of this, I actually didn't adjust out stock-based comp, which, I mean, you could remove. I think they've had significant stock-based comp. 2017 and 18, it wasn't significant. 19, it was huge, but I think that's just because of the IPO. So maybe we'll just assume, we'll just ignore it for now. The other thing, maybe you assume, oops, much more aggressive growth on the delivery business, and maybe you, oops, and I just moved that screen away for a second there. You know, if we assume delivery is actually going to grow and become bigger than mobility at some point and be this $50 billion, you get all your groceries, everything through Uber, still not even close. Pretty crazy. Pretty crazy. And I actually don't think that's possible. I don't think it's going to get bigger than here. Let's just have it do that. So you're still having healthy growth now. And now if we look at like total revenue growth, right? You're in the high teens going into the low teens. You become a $70 billion. And let's say we believe the COGS story. We don't believe the COGS story. We believe this is going to go down starting next year till it gets down to like 20%, because they're just going to be autonomous vehicles and you're no longer going to pay people, and that's going to be fully implemented by 2026 in 5 years. Yeah, undervalued now, right? So, but if we say it's just going to be an instant impact, you're going to stay at 50%, right, for until 2026, and then 2026 you're going to drop down to 25%. Yeah. So, I mean, maybe it doesn't even have to drop that much, right? Say 30%. Yeah, looking good. 35%. Oops, let's do that. Looking good. So, I mean, I think based off this, the play in Uber is, do you believe that autonomous vehicles are here? Uber is going to win that war, and they're going to be able to significantly reduce the cost of providing their delivery services of people and food. If you believe that, yeah, Uber is probably about fairly valued right now. That's what it looks like. It looks like probably a 2026 timeline, something like that is priced in. Somewhere in there, they're going to see significant savings to their COGS profile from the implementation of all this R&D spend. And obviously Sgna, we're making huge assumptions here, right? If we assume they're only going to reduce that like 3.5% a year, probably a completely different story even then. But those things will go hand in hand, right? As they reduce their Sgna, that's going to be a direct result of them implementing a self-driving car, right? R&D will probably stop a bit once they have kind of the core tech there. So Uber's an interesting one. I think it's right now people are really assuming the self-driving piece is going to take in, or they're assuming that freight business, which I mean, I don't know too much about. You could be assuming that that's going to go from being $1 billion to a $20 billion company and things of that nature. In delivery, they're just going to continue to take over that market. It's interesting because they have a lot of promising things all around kind of the delivery aspect, and if we really move to autonomous vehicles, obviously they're the ones positioned to capitalize on that, or Tesla, right? That's the other rumor. But yeah, so definitely was a fun one to look at. I hope you found it useful. I'll post this up on there'll be a link to download the file, and feel free to poke around in it. Thanks so much.